Well, hey there, everyone. Happy Tuesday, January 20th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from kind of beautiful winter day here in Redmond, Washington. Wow, is my reaction to Black Tuesday, or whatever we want to call this big time distribution day that hit us after the long holiday weekend. Certainly saw the signs of this, the hints of this emerging over the weekend as communication about escalating situation in Greenland. And again, hard to imagine that that is an epicenter of global conflict, but apparently it's on the list now. Nothing's off the table at this point in terms of crazy things that come seemingly out of nowhere, as it feels like. However, a lot of discussion, a lot of banter and back and forth as global leaders and other somewhat important people end up in Davos, however we pronounce that city in Switzerland, and feel important to talk about important things. But certainly a lot of banter about geopolitical issues. That discussion, that debate, that uncertainty, that instability being reflected with risk assets rotating lower. We saw that yesterday with non-U.S. markets that were not closed for the Monday U.S. holiday. As the U.S. markets reopen today, we have bonds selling off, we have rates going higher, we have equities, cryptocurrencies rotating down, volatility spiking. A lot of those red flag kind of things we talked about seem to pop out pretty big time today. Now, what we will attempt to do in today's episode is try to put today's pullback into proper context. Let's look at the charts together. Let's review what has happened so far, what this means for the long-term trends, because what you're going to find, I think, is that for a lot of individual stocks, the long-term trends are still in great shape. In terms of the major averages, this is at least a brief tactical pullback, right? If nothing else, this is a bit of a pullback scenario, and we'll talk about some potential downside targets now that we are out of the green light and back into the yellow light range on our traffic light structure, looking at the S&P 500 as we close back below 6,900. As I'm sure you can guess, not getting out the horn today, have it all ready to go, ready to play something. Maybe I'll put it in the background over here off camera, off my right shoulder. Maybe that will appease the market gods and we'll get a push above 7,000. But in the meantime, shall we look at the chart together today? As a reminder, 3 parts to the show every trading day. We'll look at the market update. We'll look at what happened today through major asset classes and ETFs. We'll then look at the heat map and talk about some of the group and sector and individual stock themes in the major U.S. equities. And then we'll look at some hand-selected charts that I've grabbed through the course of the day today. S&P 500 down at 2.1%. Certainly the worst day so far in 2026. The worst day in quite some time. It feels like we've had such a low volatility environment with the VIX down in the mid-teens, which basically implies days like this should not be particularly common. With the sell-off, we're seeing the VIX spike above 16 and finishing the day indeed above 20, which is our sort of back of the envelope separation between low volatility and high volatility. So we'll see how Wednesday, Thursday, Friday continue as we, I'm sure, get more geopolitical updates from the events in Switzerland, as well as a lot of a fire hose of earnings, to be honest with you, coming through with year-end earnings for major U.S. companies. Having said that, the S&P closing below 6,800, that's down 2.1%. The NASDAQ Composite down 2.4%. The Dow, which outperformed, not by much, still down 1.8%. Mid caps and small caps both down about 1.3 to 1.5%. The VIX moving above 20. It did get high as 21 earlier in the day. It did come off just going into the close, but certainly above our threshold to separate a low volatility environment from a high volatility environment. So what do you look for here? VIX remaining above 20 would not be a good thing. And I would say generally my experience is the longer the VIX remains above 20, the more there's uncertainty, the more that fear is becoming rampant. And that usually does not inspire great risk taking, that more inspires risk aversion and risk off moves in key averages. And we're seeing that. Certainly, we've seen that in a lot of ways going into today's session, but certainly we're seeing offense underperforming defense. You're going to note one of the more defensive sectors at the top of the leaderboard today. So all those signs of a downside rotation seeming to come out pretty good today. The bond market's quite a bit of movement. The TLT, one of the biggest down days we've seen there, down 1.3%. Rates generally moved higher, the dollar moving lower. And we're going to show you a chart comparing the US dollar to the 10-year Treasury yield. Now, these are complex. As much as we like to simplify and say, all right, if this happens, the dollar does this, that means this. Which you have to remember, there are a lot of different factors that determine the value of the dollar index, which is not a tradable security, right? It's a weighted index of a bunch of different cross rates: dollar euro, dollar yen, dollar British pound. All of those based on trade relationships are all sort of combined to create sort of a weighted dollar average. This is the general weight or general strength or weakness of the dollar versus a basket of other currencies. So, as much as it's hard to draw, simple relationships, and I just try to avoid that because I find you're making a ton of assumptions there. If there was a way, I would summarize what happened today with rates moving higher, which means bonds sold off and the dollar sold off. That means investors are getting nervous, but they're not flocking into U.S. Treasuries. If that was the case, we'd probably see bonds going higher, and we would see the dollar going higher. With bonds selling off and the dollar dropping, that implies a lack of confidence in U.S. markets, in the U.S. economy. Not surprising, given the general sort of vibe we're getting from, and again, I don't want to get political, with the general observation of language that we're seeing, and certainly separating the U.S. As an economy and as a nation versus other traditional allies. And so we're seeing that lack of confidence reflected in the fact that both the dollar and bonds are selling off today. One day, so let's see what happens through the course of this week and certainly as the quarter progresses. But for now, that's an emerging theme to pay attention to. So if the dollar's down, if bonds are down, if stocks are down, something's got to be up, right? And it's true. And the answer is commodities. Gold up 3.8%. for a new high for gold. Silver up 5.4% for a new all-time high for silver. Copper, the only one of these major commodity ETFs down. Crude oil slightly higher. The natural gas ETF, ticker UNG, up 20% today. So we're seeing a big move away from other asset classes. When you think about, rock, paper, scissors, and what ends up on top. This is rocks over paper is the way that I would describe what we saw today, with gold and silver outperforming paper assets. All right, looking at Bitcoin in a downtrend here in the last 24 hours, we pushed up just briefly above 93,000, but as we transitioned into Monday into Tuesday here, and the U.S. equity markets being open after the long holiday weekend, cryptocurrencies essentially selling off fairly consistently alongside equities. So Bitcoin currently down 3.3%. That's from Monday, around 89,500. Ether price is slightly below 3,000. That's down about 6%. And you can see all top 10 cryptocurrencies in the red today. I did not trim my position in Bitcoin that I added recently, but certainly looking at it here after today. Looking at the 11 S&P sectors, consumer staples number one, and that is the only one of the 11 sectors actually finishing in the green. Earlier today, I was interviewing Joe Rabel of Rabel Stock Research for the latest episode in our Market Misbehavior podcast. That should be coming your way later this week. Really good discussion. I mean, he is just a classic stock picker, a classic technical analysis oriented stock picker. Reminds me very much of the discipline and the approach that we used at major buy-side institutions, and kind of the classic growth-oriented technical analysis approach. A lot to be learned from Joe's comments and take on the current market environment. We talked about energy in particular. At the time we were recording the interview, it was staples and energy were the two sectors that were up. As the day progressed, energy slipped slightly below the zero level. Healthcare slightly below as well. Both of those are down less than 0.25%. Consumer staples, the only one in the green, and again, just slightly up about 0.33%. The real pains in the downside, you can see technology leading lower, down 2.6%, about the same for the XLY, down 2.6%. Financials and industrials both down 2+% today. Not a great day. Sector breadth wise, also looking at individual stock breadth, kind of a bloodbath by any definition, I would say. About a 3.5 to 1 ratio of stocks down versus up on the New York Stock Exchange, 77% down to 21% up. Mid caps had the worst breadth, but mid caps and small caps about a 4-to-1 ratio, around 80% down to 20% up. Our market trend model as of Friday's close, still bullish on all time frames. That's what this is reflected. Very soon, I would imagine the stock charts algorithm is going to go retest all of this and switch some of these to short-term bearish based on today's close. Again, we don't formally update our market trend model until Friday at the close. It's a weekly model. That's intentional. That's meant to try to pay less attention to noise during the week and just focus on weekly changes from Friday to Friday. So if this was the end of the week, the short-term model would turn bearish for the first time in 2026. A lot of week left, a lot of game left, as we would say. Speaking of games left, congratulations to Indiana. Can't believe I'm even saying that. Indiana University, national championships of college football. My family are big college football fans, as you may notice from the fact that random Ohio State stuff is usually in my background. Actually, that's a little container full of Buckeyes that we found on the campus of Ohio State University many years ago. So I'm a big Ohio State fan, Big Ten fan. 3 years in a row, we've had a Big Ten champion in college football, which is pretty cool. But boy, Indiana was just a fun story. I mean, they absolutely beat Ohio State in the Big Ten championship, and we lost to Miami, but Indiana did well. That was awesome. Fun to see. What a great story. So congrats, Hoosiers. Well done. All right, what else can we tell you? I'm looking at hold on a second. Why is this on the wrong list again? Give me a second here. We want to make this the Magnificent Seven. Thank you. Here we go. All of the leading growth names that I put on a list called the Magnificent Seven and Friends in the red today, starting at the bottom, because this is a big down day, big deterioration in technology, right? So we can see NVIDIA down 4.4%, Tesla down 4.2%, Apple so bad we have it on here twice, apparently, down 3.5%. I don't know why I did that. Amazon down 3.4%. I mean, this group of stocks struggled quite a bit. I mean, the one that was down the least was Netflix, which is, I would say, undeniably the worst of all of these charts in terms of the general trend. So some things that were down, that have been down a ton, actually getting outperforming a bit today. But let's be clear, this is a deterioration day, top to bottom. We're going to talk here as we get to the charts about the S&P pulling back, closing below its 50-day moving average for the first time since mid-December. We're going to talk about the momentum, which is still okay. But before we get to that, shall we talk about the heat map? And if you love the color red, you're really going to enjoy this heat map. By the way, if you have questions, and again, I was taught, don't confuse brains with a bull market. Everyone's a genius in a bull market. Those are my two favorite quotes to throw around during protracted, extended bull market phases. When stocks are down a lot, that's when we all sort of like do a double take and realize that maybe we don't have it all figured out, realize that this game is actually a lot tougher than the previous bull market phase may have led us to feel. Not saying we're in a new bear market phase. I'm just saying a day like today can be unsettling. So if you have questions on stocks and charts that you've been following, if you're thinking about challenging the challenges of differentiating short-term pullbacks from long-term breakdowns, please drop a comment, a question in our comment section of our YouTube channel. We'll be doing an all mailbag episode on Friday. We had a really good episode on last Friday with some really thoughtful questions from you guys over the last week or so. So please keep them coming. Our YouTube channel is a great place to get questions in front of us. We read all of them, and we'll highlight some of the best here on next Friday's show. So what's interesting about the heat map today, it's not just growth. And I would say there are 5 sectors here with quite a bit of red, 5 pretty big sectors. In fact, I think they're the 5 largest sectors, certainly almost the 5 largest sectors. Technology, by far, is the largest sector. It's about 35% of the S&P, dwarfing the rest of them very, very quickly. You can see that most of the names in that sector in the S&P 500 were down today. So on a day when it feels like the markets were down big, which they were, in a day when it feels like most stocks were down, which they were, it's helpful, I think, to focus on what did not go down, right? What actually held up, what either outperformed or even better, what went up on a day when it felt like everything was down. Because I was taught a rising tide lifts all boats, which implies when the trend of the market is positive, most stocks are going to be going up. When the trend in the market is down, most stocks are going to be coming off. And generally, it's kind of how that works. That's why the advanced decline lines generally follow the market trend over a period of time. But on random days, you will find there's some disagreement. And stocks that actually were not down along with everything else, there might be something there. There might be a company specific reason why a particular stock is in better shape than others. It might be more of a group or a sector theme, right? Defensive sectors, for example, today generally did better. So that's what we can do looking at the heat map on a day like today. So let's start with technology, right? The big names down quite a bit. Obviously, NVIDIA, Apple, we grabbed the chart of Apple just to talk about potential downside targets. I think it's getting close to an initial downside target according to our work. Broadcom and Oracle. So 4 of the top 5 stocks were down over 3.5+% today, which is pretty bad day. So what was not down? Micron, ticker MU, actually made a new all-time high today. I say that again. Micron actually made a new all-time high today. So that tells you that in terms of areas of the market to be optimistic about in the growth space, Micron making new highs, AMD, which did not make a new high, did break out of a resistance last week and basically was flat for the day. So while the major averages were down 2+%, AMD was flat. Intel actually was up 3.4%, pushing higher. The hard drive companies, Western Digital and Seagate, both continuing their uptrend. So there were some stocks within the technology space that are still in that primary uptrend. Lam Research, LRCX is another semiconductor. This is something we talked about in our 2026 market outlook. This is something it's come up with a number of interviews with on the podcast recently, has been this idea that we're going to go from anything involving AI doing quite well. I think Matt Tuttle last week on the podcast described that in detail very, very well. I'd encourage you to check out that interview. We're going from anything that has AI involved is going to go up kind of mentality to more, more deliberate, there are some stocks that are going to do quite well, and there's some stocks that are not going to do well. We're going to start to differentiate those. And I think within technology, that means it's not just one sector going up. We're going to start to find a little more differentiation. We're seeing maybe a bit of that today with some of those names actually positive. What else? Within the financial sector, big down day. Within consumer discretionary, big down day. Within communication services, big down day. And I would focus on charts like Comcast, still making higher highs and higher lows coming out of that, making a new 3-month high here in the month of the January. Within the financial sector, like a Fifth Third Bank, which actually is breaking out a number of earnings in the financial sector last week and some into this week. Fifth Third is actually holding pretty well. So companies that manage to have good earnings through this period could actually hold up just fine. Industrials, another sector getting dinged pretty good. Joe Rabel and I talked about Boeing. So when that interview gets posted later this week, I'd encourage you to check that out. Great discussion of areas within industrials that still show strength. So if those areas of the market, besides some of the names that I highlight, those are some of the sectors that struggled, what sectors did well? So 2 immediately, really 3 would come to mind. Number 1, healthcare. And, healthcare as a whole, kind of a mixed bag, right? You've got Johnson & Johnson coming off of new all-time highs. You have United Healthcare essentially sideways. You have like an ISRG breaking down this week, McKesson, pulling back. So it really is sort of a mixed bag, but generally there's some compelling charts in here that have actually done pretty well. Merck is probably the example that comes to mind immediately with this nice uptrend phase and pushing higher, basically over the last 6 months, but not getting bothered with today's drop. Energy, ExxonMobil made a new all-time high today, up about 0.5%. Again, not all of these charts look identical. For every Exxon making new highs, you have some others like EXE, which is well below its previous high after making essentially a double top pattern. So I think it's still, it behooves you as an investor to focus on which have the more compelling technical structures. That's why we look at charts, is to differentiate not just energy as a bet, but which energy names look actionable, look optimistic. And I think that's why I would do it. And then consumer staples, right? And this is, arguably one of the most defensive sectors. These tend to be low volatility names. A lot of these charts, like, food names like Campbell's Soup, like ConAgra brands, CAG, have been really ugly charts. But on the same time, you have like beverages like Monster, which have been in a nice consistent uptrend. Walmart made a new all-time high last week. Tobacco names like Philip Morris and Altria have been rotating higher as well. So again, the opportunities in terms of the stronger charts in some of those sectors like staples today, like energy, which has been emerging since the end of last year, healthcare, which was strong in Q4, But again, with all of those, I don't think it's as much a sector bet for me as recognizing that there are specific names that are showing strength more than others. All right, shall we finish off looking at the charts together? Here is the what we call the traffic light chart, showing the S&P 500 and this sort of traffic light visualization. Again, I like to simplify things. I like to have a rigorous, disciplined process that is not, that has a lot of things to pay attention to. But I like, simplifying your way of describing the market conditions into, real basic elements, right? And that's why something like the traffic light approach is attractive to me, because while there's a lot of things we need to think about to really get our heads around what's happening with the S&P and our expectations for what might come next and why, in terms of defining the trend, I think it can be very simple, right? I think we can look at the trend in terms of the movement of the price action, higher highs and higher lows, or the opposite, looking at the shape of the moving averages, looking at the momentum and the breadth as a way of describing it. But let's, in the end of the day, define some levels, define some key levels that we're watching. And for us, 6,900 has been an important level really since October of last year, when we first hit that 6,900 level. And then we pulled back a decent amount, about 350, 400 points down to retest the low at 6,550. That gives me the framework with which to think about what's happening next. That's where we were pretty encouraged in December going into January as the S&P pushed above the 6,900. What we've not been encouraged by has been the anemic momentum, right? This is strong upside momentum in a bullish tape, August, September, October. This is, an upside trend with meager momentum, with the RSI stalling out around 60. That's been the case since, early November, right? Those retests of 6,900 have come with less than just basically weaker momentum, and certainly not in the bullish range. So today's pullback takes the S&P back into the yellow light, which says for us to be, to be neutral, to be cautious, not be sort of aggressively playing the long side. It's not bad enough to be thinking really aggressively short here. It's more of a wait and see. Jesse Livermore is quoted as saying there's a time to go long, time to go short, and time to go fishing. This is one of those time to go fishing times, I would argue, right? It's very easy to get super nervous right up front and say we close below the 50-day and start making some significant changes. If you have a short-term time frame, I totally understand that. However, for me, I'm thinking more longer term, thinking more structural, right? Thinking more about position trading. And if you look, we've had a couple closes below the 50-day moving average, and the last time that happened here in December ended up being an initial bounce right afterwards. Very similar. We ended up making a new high about a week later. We certainly could see something like that, which is why 65.50 for me remains a key line in the sand. I think anything above there is neutral at worst, and anything below there starts to look a lot less attractive. I would say on the S&P, one thing that has changed quite a bit is the RSI, right? I mentioned how the this test of the previous highs was with weaker momentum. Now we're actually getting the RSI testing the 40 level. And if we're in a consolidation phase, I would expect the RSI to kind of generally remain between 40 and 60, which has basically been the case since Halloween of last year. However, we break below 40 and it starts to look like a more significant drawdown is a possibility. So we'll be looking for that for sure. We are planning to release our latest choose your own adventure style video later this week. So keep an eye peeled for that. That's where you watch the video. We'll lay out 4 different scenarios. Think about those, vote on which one you think is most likely. And it's a great opportunity to challenge you out of your comfort zone, to think about different possibilities, to open yourself up to other perspectives as other viewers share their bullish or bearish takes and why. I've just found it's a great way to sort of, as a community, think about some different scenarios, stretch our thinking, be more open-minded, and then we can track together how things actually play out. So keep an eye on that. That should be coming here in the next day or two. All right, here's the daily chart of the S&P 500 along with breadth indicators. The long-term breadth still in great shape. About 2/3 of the S&P remain above their 200-day moving average. That's totally fine, not in a dangerous level just yet. But as the S&P closed below its 50-day for the 3rd time since the end of October of last year, we've had a pullback in the percent of stocks above their 50-day moving average, down to around 63%. So we did go briefly above that 70% level and pulled back. I was spending some time with this over the weekend and kind of bumped in these levels. I'd usually kept it at 75 and 25. But just looking back at the last 2 years, up to 70% has often been sort of an upside exhaustion point. Down to 30% has often been an interesting downside exhaustion point. So I bumped those levels in a little bit. Just sort of keep an eye on them a little more closely. And so by that definition, we did briefly go above 70% last week, and now pulling back below there. And again, for me, remaining above 50% on a pullback would be very helpful. That would be encouraging and sort of validate the idea that maybe this is just a tactical pullback within an uptrend. All right, here's the S&P 500 along with 3 bullish percent indexes. Bullish percent index is a breadth indicator based on point and figure charts. Point and figure charts are a classic charting methodology where you track uptrends with X's and downtrends with O's. Boy, it's been on my list for a while to do like a little tutorial on point and figure charting. I feel like I keep forgetting to actually make time to do that. I'll get to it someday. But for now, just remember it is a classic charting methodology based on charting trends, not charting prices. And what I mean is the point and figure chart is updated based on the persistence or the consistency of a particular trend. And if an uptrend reverses to enough of a degree, it rotates from a bullish chart to a bearish chart as you have what's called a doubled bottom breakdown. And that would be a bearish signal. This indicator, the bullish percent index for the S&P, tells you what percent of the S&P are currently showing a bullish signal on their point and figure charts. It's around 62%. The bullish percent index on the NASDAQ 100 is down to 45%. The bullish percent index on the technology sector is down below 50% as well. So you have the S&P, remaining above 60%. You have the NASDAQ 100 and the technology sector both much lower. So look at how the S&P's bullish percent index still kind of generally going higher. And then these other two, NASDAQ 100 and technology, rotating lower. This is just yet another way of demonstrating this rotation from growth into value, from leadership for most of 2025 to what we see as new leadership, more value-oriented sectors, some defensive sectors starting to pop up as well. But this, sort of disagreement, this divergence between the S&P's bullish percent index and the rest just speak to the fact that growth generally as a whole doesn't seem to be leading the markets here to kick off 2026. Here we have to tell you the VIX is above our red line of 20. It's actually a blue line on this chart. Maybe we should make it red, but it's above our threshold from a low volatility to a high volatility environment just for one day. This is the first time it's above 20 since November. If it would remain above 20 through the course of this week, we would see that as a really negative sign, speaking to heightened sensitivity or heightened anxiety in the options market pricing in much bigger daily swings on the S&P. And the further that goes on this scale, it's basically a higher daily percentage swing that the options market is pricing in, looking at S&P 500 index options. So last couple of times we had a spike above 20. It was only above there for about a week and a half. In both cases, those were major pullbacks in October and November, but we ended up resolving higher soon afterwards. And the VIX coming back below 20 was a good sign, sort of an all clear to that pullback phase. That's something we may be looking for here in the days and weeks to come. I mentioned in the initial discussion of the market action today, the dollar down, rates up. So, this is one of those warning signs, I would say, in this environment, given the uncertainty about, U.S. markets and the U.S. economy, given a lot of question marks coming out of the government shutdown about inflation and certainly more recently about stability with all the global uncertainty with Greenland and Iran and Russia and Ukraine and the Middle East, and add whatever else you want to that list of things going on in the world that seem, somewhat unstable or unsettling for potentially for global markets. If the dollar drops and bonds drop as well, and we're showing it here in the form of yields going up, that implies that investors are getting nervous and not moving their money into U.S. assets, but probably parking them elsewhere. And it's not a good sign, right, for optimism in the U.S. Economic growth. If that was the case, we would expect investors to be converting to U.S. dollars and buying U.S. treasuries as a relatively safe haven. We're not seeing that move here, at least today. We'll see what happens over a course of trading days going forward. Gold remains with kind of this bearish divergence, but this gap higher, putting gold to new all-time highs. Similar breakout in silver. The uptrend has been in place. We still have a decent position in the GLD because of this consistent uptrend. We're overbought again, but again, higher highs and higher lows, generally speaking, are bullish. Bitcoin rotating lower while gold and silver are rotating higher, and generally speaking, the commodity complex. Bitcoin trading more like risk assets, rotating lower here. Over the last week, Bitcoin touched 98,000, currently around 9,000 points lower, currently around 89,400 here. The momentum is still okay with the RSI just above that 40 level. That's something we're watching here. We're also testing that swing low from earlier in January. We're looking at that as well. Today did close below the 50-day for the first time since the beginning of January. So, generally speaking, a push above 94, 95,000, that was the trigger for us. This appears to be a failed breakout, and unless we can recover that 95,000 level, looks like a questionable, pullback after a failed breakout situation. Offense over defense now very much favoring the defensive side of the coin. If you look, consumer staples has been outperforming on both a cap-weighted and equal-weighted basis. That's after this ratio made a new all-time high as trading began first full week in January. From there, we've actually rotated lower. And what that means is things you need, consumer staples, doing better than things you want, consumer discretionary. This ratio has often been one of my favorite ways of thinking about, investor sentiment through the lens of consumer stocks. Because things you need, like cleaning products, personal care products, toilet paper, beverages, tobacco, these are all things that are relatively immune to economic shifts because you're still going to be paying for those things and probably not necessarily upgrading those things when conditions are good or bad. It's just things you kind of always need. Discretionary purchases are things you might spend more on for luxury goods, for travel, new clothes, a new car, those sorts of things. You can spend a lot more or a lot less depending on your situations. Those are more economically sensitive. So consumer discretionary underperforming consumer staples implies that investors are rotating to more defensive positioning, representing a bit of a risk off feel in the current market environment. That ratio looked really good in December, starting to look not so good here to kick off the new year, and a pretty dramatic change as trading began here earlier this month. Boy, we're long on time, so I'll go kind of lightning round style through some of these charts. If you have questions on these charts, or if there are tickers we didn't cover today that you'd like me to consider for a future episode, hey, drop a comment, let me know. Always open to your questions and suggestions. Alphabet we are highlighting because last week we talked about the overbought condition. We talked about this shooting star candle as we became overbought, which told us maybe not a good sign, maybe a bit of a pullback situation happening. That has now played out. We are testing the 21-day EMA, which has been a frequently tested moving average going back to June of last year. So we had a bunch of pullbacks within this uptrend. After being overbought, we get down to the 21-day EMA, rinse, repeat, we move back higher. I'm not sure if we're going to see the same thing here this week, but that's something I would be keeping an eye on. If you get much further, certainly if you get below the 50-day moving average around 310, if you get below the swing low here around 295, we have to acknowledge that maybe it's no longer a primary uptrend and start to think about, further levels of support to deal with. But for now, Alphabet in a tactical pullback within an uptrend. Within the technology sector, we highlighted some of the weaker charts. Dell is a chart that we highlighted last week. Shout out to Rachel Dashel at Schwab. She did a presentation for the TSAA based in San Francisco that I participated in. I think that was last week. Great example of a head and shoulders topping pattern. I would say today, it certainly seems like we've broken down through that neckline after bouncing above the neckline last week. Today's drop down about 7.5% takes us below that neckline. Look for follow through tomorrow to see if there's further deterioration. But overall, Dell in a position of weakness. And it's not just, dude, you're getting a Dell. It's other charts as well in the technology sector. Apple potentially hitting an initial level of support. We'd highlighted some moving averages. We highlighted the November swing low, but once those were broken, that's when I start to take a big step back. That's why I tend to bring out and unroll the Fibonacci retracements to think about some longer term levels of support. And if we look at the April 25 low and we look at the December 25 high, 38.2% of the way down is around 243. That's almost exactly today's intraday low. And if you look to the left, that lines up pretty well with the swing low in October. I think we're down to an initial level of support. Below current levels, you have the 200-day moving average currently around $234. So we're oversold as we test this range of support. This is probably the general area. What I would think in this scenario is kind of between the 38.2% retracement and the 200-day, kind of in this 235 to 245 range. That's kind of the level where you'd probably expect some sort of, tradable low, some sort of bounce. The question is, how high would that bounce get? And do we see any further weakness? Does the momentum improve, implying accumulation? None of that is happening now. We're still in a downturn, but kind of near that point where I would be looking for a potential bounce here. Got a question over the weekend on GE Aerospace. When we think about the industrial sector, it's not all great, but one area that has been great has been aerospace defense types of names, and I would put GE Aerospace in that particular bucket. GE, if you remember, used to be that conglomerate ticker, but now it's separated into a couple different publicly traded names. GE Aerospace kept that same ticker, made a new all-time high earlier this month, pulling back and still not bad. It's kind of like Alphabet's testing the 21-day EMA, still a good chart. The momentum is still good, right? We're making higher highs, we're making higher lows. The momentum is good. 50-day moving average is just below current levels, around 305. What I would look for on a pullback is we remain above 280. That's a little more of a longer-term way of thinking of this, but in a noisy environment with the volatility increasing, you got to give some natural room for these stocks to actually have a pullback. And think about what level would tell you this is still an okay chart. And I think above 280 is still a good chart. It's just a pullback because it's a higher low. We break below 280. That's where I would be setting a stop on the chart. That's where I'd be setting an alert, which I'm going to make a note to do now. 280. I think anything above that is kind of neutral, right? Kind of okay. All right, defensive sectors doing better today. We've highlighted some breakouts in consumer staples. Today we're going to highlight molten cores. That's a tough one to get out sometimes. All right, so we had a breakout above the 200-day last week. Friday was a down day, testing that 200-day moving average. Today, lower open, higher close. That's called a bullish engulfing pattern. I would label it that way after this breakout and a pullback. We had Friday's sell-off. Today's rally implies that investors buying in on the weakness coming out of the weekend, implies short-term improvement as we, hopefully confirm a break above that 200-day moving average, but an encouraging chart on the intermediate term with stronger momentum and improving relative strength. Folks, that'll do it for today's episode here on Tuesday, January 20th. Thanks so much for watching my content. Thanks so much for following my work here on my YouTube channel and elsewhere where you see where I'm at. Please take a moment and drop a question in our comments section. We'd love to hear from you and may feature your question on Friday's episode, an all mailbag episode. Great show on Friday where we answered some of your questions, viewer questions from the last week or two. So please check that out when you have a moment. Also, last two episodes of the Market Misbehavior podcast with trading expert Jason Shapiro, unknown market wizard Jason Shapiro, and portfolio manager Matt Tuttle of Tuttle Capital Management. Two really very different but fascinating interviews, I thought. I hope you find those helpful. More episodes coming this week. In the meantime, have a great night. And remember, it's always a good time to own good charts. Take care, folks.